So this is probably a question I get at least 2-3 times a week, which is, should I use my HELOC as a down payment on an investment property, right? So let me briefly explain for those guys that don't know that HELOC is home equity line of credit. So you have equity in your primary home most of the time, or it could be a residential property or investment property as a single family home. But you're pretty much leveraging the equity in that property to get a line of credit from a bank. And what the question is can I then use that line of credit and buy an investment property, like an 8-unit or a 6-unit, and just use a line of credit as a down payment? So here's the answer is you can. Now the question is, should you? So I'm going to do my best in this podcast to not only tell you the pros and cons, but if you're going to do it, this is the way you should do it. And this is how it makes sense. So let's start with the pros and cons. So first pro is that you use less of your actual cash up front. Now, this is why this is such a pro, aside from just keeping as much cash as you possibly can, is because for those of you guys that have been living under a rock, we are in a very high inflationary environment, right? Inflation is more than it's been in the last 40 years under this current regime or administration, as you could say. And when you have a very high inflationary market, it's very good for you to use as less cash as you possibly can and actually deploy it to other things that make more sense and make that money expand as much as you can as well. So that's pro number one. Pro number two is it's great if you have a great deal. So if you have a property that's cash flowing 18%, 17% cash on cash return a year, you find a great deal, you find maybe a seller that's distressed or motivated, you find a creative way to do so, the cash on cash return is amazing, then using a HELOC is phenomenal. That's why a lot of times when people ask, hey, can I use a HELOC to buy an investment property? My answer always 99% of the time is it depends. Depends on the skill set of who you are as an investor, depends on the deal, depends on the numbers, it depends on the interest rate and the terms of the line of credit. It depends on a lot of things. But if you find a great deal, it's a great opportunity. It's a great route. Pro number three is that you don't have to split the deal with anyone. And I know this probably better than anyone firsthand because a lot of the deals I've done in the past, whether it was a 36-unit apartment building, a 24-unit, an 8-unit, a 4-unit, I've done a bunch of single-family homes, done Airbnbs, I've done a lot of different things. For 90% of those transactions, I've brought on an investor. And I will tell you that there are times where I don't cringe, but I hesitate. I wince. There you go. That's the right word. I wince at the idea that I did 99.99% of the work and I'm giving away 70% of all my proceeds, all my depreciation, all my long-term wealth creation, equity, principal, you name it, right? So there's a great pro with utilizing a HELOC to buy an investment property is you don't have to split the deal with anyone. You become your own limited partner. Now, if you want to get fancy with it and start assigning different entity structures, different tax structures, you talk to a really good CPA or a really good attorney who knows how to separate your money as is and could do wonders for you on the tax side, so be it. That's another phenomenal benefit as well. So you don't have to split the deal with anyone. That's a great pro. Now let's move on to the cons. So the first con is that there's an increased element of risk. Now, I'm going to preface this by saying the biggest difference between an average real estate investor, a good investor, and a great investor, for me in my eyes, is how well they manage risk. How well do they mitigate risk? A below average to average investor will not consider the risks at all. They'll run the numbers, they'll look at the cash flow and the upside only, and they'll make their decisions based on that. An average investor knows only the risks that the average person is going to know about, right? So maybe stuff with inspections, properties, maintenance, repairs, anything of that nature. A good investor will consider maybe one or two elements of risk. A great investor will play the line between what's possible and what's probable. A great investor knows all the risk under the probable section. Like, hey, based on the scenario, based on the seller, based on the numbers, based on the deal, these are the risks that are probable to happen. Not guaranteed, not impossible, but probable to happen. But they also avoid the what ifs, the what if game. Well, what if this happens? What if a meteor strikes the earth? What if there's another COVID pandemic? Which I hope there isn't. But that's what great investors do. And we're going to talk a little bit more about that when I get to the core four of if you're considering using a HELOC to buy an investment, this is what you need to do, right? So con number two is your net margin gets thinned out. Obviously, there's a cost of borrowing with anything especially when it comes to banks. There's a cost of borrowing. And if your cash flow is already at a 15 or 10% margin of your gross income, so if you're collecting $1,000 in rent, let's just say half of it goes to expenses such as taxes, insurance, utilities, maintenance, repairs. And let's just say like 35 to 40% goes to your existing first position debt service, right? So that's the 30-year commercial loan that you're getting or the residential loan that you're getting. Obviously, you're using the HELOC to pay for the down payment to get the loan. That said, usually in most cases, your debt service is going to be around 30 to 35, maybe even 40%. So if you already have 15, 10% of your gross income that you're collecting as cash flow, well, now that also is being stripped away. The cost of obtaining that home equity line of credit, which might be 7%, 8%, 9%, 10% of whatever you borrowed in simple interest, because that's the difference between lines of credit versus a traditional mortgage, so to speak. So now you're talking about your 10, 15%, a very slim margin being chipped away by that. And one could argue one repair job, one roof that has to be replaced, one hot water heater that has to be replaced, one furnace that has to be replaced, your margins are then already gone and you're in the negative. And all of a sudden you start wondering, why did I even do this deal? A lot of people end up in that scenario. Okay, so here's last but not least, con number 3, is that in the current market, the rates have changed. In fact, if you look at the last 2 years, in 2023, 2022, within an 18-month stretch, the Federal Reserve increased their rates a total of 5%. So 500 basis points. And if for those of you guys that don't know, it's the fastest that the Fed has increased their rate in any other time in history in terms of acceleration. And that happened all within an 18-month span. So you can imagine how the banks reacted to it. They jacked up their rates as well. They skyrocketed their rates, whether it was on home equity lines of credit. Any lines of credit, by the way, can apply to this episode, whether it's a PLOC, a BLOC, any lock, LOK, LLC, you can apply to the stuff that we're talking about right now, right? But that's the con, is that in this current environment, it might not be the best thing to do, considering how expensive it is to just borrow money in comparison to what we've experienced the last 3 to 10 years. So let's say you still want to do this, right? Say, hey, I listen to the pros, I listen to the cons. What do I need to know? What do I need to do to see if this is a good fit for me? So this is my core 4 of if you're going to utilize a HELOC, this is what you need to keep in mind. So first and foremost, build a relationship and speak with your lender. Now, this sounds obnoxiously obvious, but let me tell you why it's not, and let me tell you why it's super duper important. Because 99% of people that talk to their lender when it comes to a bank, whether it's a HELOC, a line of credit, a 30-year mortgage, a commercial loan, it doesn't matter what it is. 99% of that conversation that the average person is going to have with their lender is going to entail the logistics of what it takes to get the loan, to get the money, not what are the risks and the downsides of getting that money. I mean, think about it, guys. With a 30-year mortgage, when's the last time anybody getting a 30-year mortgage has asked their lender or their mortgage broker, hey, what are the risks of me getting this 30-year mortgage? Because I'm not a licensed lender. I'm not a mortgage broker. I'm not in, the institutional lending space, so to speak. But even I could tell you 2 or 3 risks that the average Mr. or Mrs. Johnson is going to have to undertake in getting a traditional 30-year mortgage. Most people just don't want to think about it. They just want to get the bare minimum of what they need to do to get the money to get the home. That's just how people think. And unfortunately, that's how 99% of people approach utilizing a HELOC to obtain an investment property. So here's point number 2 out of the 4. Your LTV must be solid on both ends. Now, for those of you guys that don't know, LTV is loan to value. And what it pretty much is the balance of the loan compared to the value of your building. So if you're buying an investment property and you put 20% down, your LTV is 80% because the balance of that loan, because you put 20% up front, is going to be 80%. So let's just say $80,000. So you buy the property for $100,000. The down payment is $20,000. The balance in your mortgage is $80,000. So it's the balance to the value, which the value is $100,000 because that's what you bought it for. $80,000 is the balance of the loan. 80, 100, LTV is 80%. So when I say track your LTV on both ends, I mean the property that you're leveraging the equity from to get the other property and then the other property as well. And this is where you have to speak with your banker, because a lot of times when you're buying an investment property, utilizing a line of credit will affect LTV, and sometimes it won't. It'll affect DTI, which is debt to income ratios, and sometimes it won't. So keep in mind, especially if you're using your personal residence, that we don't go above a certain LTV. And you may have to ask the banker what that LTV is. Sometimes it might be 70. Sometimes it might be 60. Some of you guys only have maybe 20 or 30% of your home paid off, and you're trying to leverage that equity to do a deal. In that case, again, I'm not a financial advisor. I'm not a licensed. I personally would not do that if I was in your situation. So make sure you track LTVs on both ends, the properties to and from. Okay, number 3, run your numbers. Again, this sounds really obvious, but let me tell you why it's not and why it's super duper important. Because what investors tend to do, 99% of them will buy the deal just because of cash flow positives. And that's not true. You shouldn't, every deal that cash flows positive, you should not get. Because remember, guys, what we talked about earlier in this episode, the higher the risk, the better that reward better be. So if you're using a home equity line of credit to acquire an investment property, that's a higher risk profile. If you're experiencing a higher risk profile, you better have the reward to back it up. AKA, the higher the risk, the higher the reward. So this is the question I love asking in every single deal that I look at. And at this point in my career, I probably look at thousands of deals every single year. I always ask myself, is the juice worth the squeeze? As in, if I'm putting up this risk, if you're utilizing a HELOC, if you're getting a traditional mortgage, if you're doing all these things to buy the investment property, but at the end of the day, you're only cash flowing $100 or $150 a month, well, my question to you is $150 really worth the risk that you're putting with having a HELOC pay as your down payment to your mortgage for an investment property? Is it worth all the work? And if you're managing it yourself and you're still only collecting $100 to $150 a month, is it worth getting up at 3 a.m. and fixing a toilet? Is it worth dealing with tenants? Is it worth putting a management structure together? Is it worth doing all the work, maybe even doing the work yourself when it comes to maintenance and repairs? Is doing all that work worth the $150 that you're getting a month on top of the risk, the financial risk that you're putting on yourself by using a HELOC as a down payment for this investment property? That's something that we have to really, really consider. My recommendation is if you're going to utilize a HELOC, your cash on cash return better be double digits after taking into account the cost of getting the HELOC and everything else, your expenses, and yes, accounting for reserves as well. That for me is my personal rule of thumb. Okay, let's move on to the last one, the last of the core 4. Go over the risks with your lender. Now, it sounds familiar to number 1, but I'm going to double down on this. I'm going to double down because there's a lot of risks that people don't consider when utilizing a HELOC to get an investment property. For one, your HELOC could freeze. That's happened before. When times get tough economically, banks have been known to sometimes freeze HELOCs, right? Now, if you're utilizing our accelerated strategy, a lot of that risk is mitigated. It goes away, which if you want to check that out, there's plenty of other videos that we have on our YouTube channel for you to be able to observe that. But not only can HELOCs freeze, but your DTI can change as well. But there's also the element of fixed versus variable rates. If your HELOC is at a variable rate, well, what happens if the rate increases? What happens to your cash flow? It plummets because the cost of what you use to get the investment property has now increased more and more and more and more. So you might find yourself having done all that work to get the HELOC, to move it, put the loan structure together, put the capital structure together, put the management, all that stuff. You might find yourself doing all that work and not having any cash flow to show for it at all. And before you know it, the bank is the one taking all those profits and the cash flow. We don't want that happening. Which leads me to the last point I'll make under the guise of number 4, which is going over the risks with your lender, like actually sitting down with your lender and going through the potential risk of what could happen if you were to do this. But it's that the risks and the elements of doing this will differ from bank to bank. My recommendation is find a strong regional bank that you're familiar with, that you could trust, and start there. Why? Because a strong regional bank usually has the strength and the numbers and the validity of a bigger bank, but they have the flexibility in terms and interest rates of a smaller bank to generate business and to generate revenue. So don't do any hard pulls on your credit. Maybe don't get yourself in underwriting, but maybe have a conversation with about 2 or 3 different lenders to see if this is for you. Thanks for watching. Hope you enjoyed the episode.